Relinquishing your U.S. citizenship or leaving your high-tax country that taxes your worldwide income does not automatically then stop your taxes around the world. Only careful planning and knowing how taxes work will stop all your taxes. Doing what I just mentioned gives you the option but not the absolute right to get your taxes to zero. If you then move to a country that has either a territorial tax system or a pure tax savings status, or a country that has a non-dom tax system where you then have total control on what you pay in income taxes. Also, folks, if you want to legally get your income taxes to zero or how to get a second passport as quick as 45 days, do three things. Hit the subscribe button on the right of your screen right here and the notification bell next to it, and you'll get new videos automatically as they come out. We've got over 700 videos now that will help you do this. And number two is I would like to hear from you. If you got a question or comment, just put it below. Number three is go to our website, www.citizenshipquickly.com, and just ask for some help. Now, the reason I say this is when you legally get out of your taxes where you're living before whether that country taxes on a worldwide basis because you stay more than 183 days in that country each year, or you're taxed on your worldwide income only because you are a U.S. citizen, these facets alone will not actually stop your tax. The reason I say this is if you invest in real estate or equities in that new country that you invest in, you will have in most cases a stamp duty if it has no capital gains tax, or you could be paying more in property taxes than you were in the USA or wherever you came from. If you invest in equities, most countries will have a withholding tax on dividends that can be as high as 35%, like for instance Switzerland. So you would lose over a third of your money each time a dividend is given out to you in this instance. Now, this tax is taken out automatically before you get your dividend. You'll see this taken out on your broker statement. The way to get around this is to buy stocks that don't issue dividends, or if that country does issue dividends, make sure that country does not tax them. There are right now 21 countries in the world that do not tax dividends to non-residents. Some of them are countries like Hong Kong, the UK, Singapore, and there are many others also. There are loads of stocks in the USA that you would not be taxed on the dividend if you were not a U.S. citizen, not a U.S. resident, and you didn't break the substantial presence test. Some are companies like Facebook, Amazon, Google, Berkshire Hathaway, and there are many other ones. There are problems with even buying these stocks tax-wise, even if you are a non-resident alien of the USA, and that is when you die, the estate tax kicks in on all U.S. equities starting at 40% on all U.S. assets over only $60,000 U.S. dollars total. Now, the estate tax threshold in the USA is a lot lower to where the estate tax kicks in for non-resident aliens than for U.S. citizens and for U.S. residents. Now, the way around the estate tax in the USA is if you are a non-resident alien is to not buy U.S. stocks, U.S. ETFs, U.S. mutual funds, or U.S. real estate, even if they have foreign equities in the fund itself. The U.S. government looks to see if the entity that holds the investment is a U.S. company, or if the ETF or mutual fund company is a U.S. company. Any money you have in that U.S. company would be subject to the state tax limits on everything over $60,000 U.S. dollars total. Even if you do this through an offshore bank, it's still not going to it's not going to make any difference. The way for a non-resident alien to buy equities on a U.S. stock exchange, whether you buy the equities through a U.S. broker or an offshore broker, is to buy foreign stocks, also called ADRs, on the New York Stock Exchange. Now, under current U.S. laws dealing with taxes, these stocks would not incur an estate tax because they're not U.S. stocks. If you then want to avoid the tax on the dividend and the non-resident alien estate tax, then buy only ADRs, which stands for American Depository Receipts, that either do not issue a dividend, or if it does issue a dividend, that country where the ADR is actually from that issues the dividend does not have a withholding tax on those dividends, such as Alibaba. That's a foreign stock which is out of China. Now, ADRs are foreign stocks sold on the New York Stock Exchange. I'm not advising you to buy Alibaba or any other stocks I mentioned in this video. I'm just telling you this is how it would work with these particular stocks. I'm just giving you examples of stocks, at the current time that don't issue dividends. Now, you also have this estate tax threshold of a $60,000 US dollar limit when you're buying real estate in the USA if you're not a non-resident alien. So if you are or you become a non-resident alien, you need to be aware of this $60,000 limit and the rules that I've just mentioned to you about dividends and how they're actually taxed. There are some countries that do not tax dividends to non-resident aliens, but they will hit you with a stamp duty instead. Let me give you an example. The UK hits you with a 0.50% stamp duty when you buy on the London Stock Exchange. So if you invest 500,000 pounds sterling into a stock, you're going to get hit with a stamp duty around 2,500 pounds sterling. This is done if you buy on the London Stock Exchange. Now, if you buy on the London International Stock Exchange, this stamp duty is not in place, but you will have a dividend withholding tax on the stock unless that international stock doesn't issue a dividend or does not tax dividends. Now, Hong Kong, for example, has a stamp duty of 0.13% to buy and sell stock and also transaction fees. Now, you know, the amount of 0.13% doesn't seem like that much, but that's based on the total amount that you're investing, whereas the tax on a dividend is only on the dividend and not the capital gain of the stock itself. So you're only being taxed on a partial amount of the actual profit, whereas the stamp duty is based on the whole amount that you're actually investing. So this is something you really have to take in mind when you're doing this. Now, I don't know of any country in the world that has a capital gains tax on equities to non-resident aliens. So that's one nice thing about being a non-resident alien and you're investing in equities. You know, you don't have that tax on capital gains on stocks. Now, if you want to avoid property taxes, then just buy in areas that do not have a property tax, or you know, where the property tax is so low it almost doesn't exist, like St. Kitts, for instance. St. Kitts only has a property tax of 0.20% of what you're buying, with a $29,600 US exclusion before that 0.20% kicks in. This is about 12 times less than what the property tax is in New Jersey. There's also no income taxes on rental property on the primary home in St. Kitts, and you know, also on rental properties as well. So you know, very few countries in the world do not will exclude the income tax on rental properties. Panama, for instance, has a real messed up property tax law. Let me give you an example of how it works. It used to be, when I lived in Panama, that the government would let you buy properties that needed fixing up in the canal zone, and you could get the property tax exemption on the property for 15 years, and then at the 16th year it jumped to a whopping 2% of the value of the property. Now, the problem with this was the closer you got to the end of the 15 years, not only did you want to ditch the property, you know, to avoid the property tax, but you found out that so did everybody else, because they didn't want to pay the 2% property tax either, so it affected the property value. Because as it, you know, the closer you got to the 16th year, the more people did not want to buy your property because they didn't want to pay the 2% either. And the value of your property just went down further and further as you got closer to that 15th year. I mean, it really was a stupid law, but they've had this on the books for years. They should either drastically lower the property tax or just scrap it entirely in Panama. If you move to Panama, just negotiate a cheap price and rent the property and don't buy there. And you can avoid the property taxes altogether. Folks, if you want to learn more on this, on how to get your taxes down to zero, close to zero, go to our website, www.citizenshipquickly.com, and ask for some help. And folks, don't forget the subscribe button to the right of your screen right here and the notification bell next to it. We've got over 700 videos you get. And number 3 is, I would like to hear from you. If you got a question or comment, put it below, and I look forward to talking to you in the next video. Take care.